So everyone has a different opinion or views on getting rich, what beer to drink at a bar, or even how to get six packs. And in recent times, the stock market has created and destroyed many traders. And I also got hit by the market as well. I've made pretty bad decisions in trying to buy options and buying penny stocks. But today, let's talk about my investment strategy and why I'm doing what I'm doing. Hello beautiful people, welcome to the channel. It's Jorden here once again with yet another video. Thank you so much for tuning in. If you're new, hello. And if you have been a long-time supporter, thank you so much for always stopping by. So when it comes to investing, there are 1001 ways to spread your eggs or your money around. Some will go for growth stocks like Shopify, Alibaba, Amazon, and many more. Some goes for trend stocks, or some would refer to them as meme stocks like GME and AMC. And there's a bunch of people who will go for dividend stocks or ETFs like the STI ETF, SPHD, Philip Morris, Coca-Cola, and much more. Definitely each of these strategies has its pros and cons, minimum requirement entry, risk factor as well. But do you know what's no risk? It's hitting that like button down below. Do take note that none of this is financial advice, and before investing in any instrument, please do your own research and due diligence before investing any money into any sort of financial instrument. So the first type of stock that we have is actually called growth stocks. This category of stocks is like Facebook, Twitter, Amazon, Netflix, most of the FANG family in fact. Most of these stocks are in the tech industry, and these stocks often beat analyst estimates, reporting new partnerships, new successes, new customers, and huge growth. One of the pros of buying a tech stock is that a single investment in a big winner can make you rich, like filthy rich.
Here comes the money!
Here we go!
Like Apple, for example, after the stock split, they are still maintaining a good price, and analysts predict that it will continue going up, which kind of makes sense to me because, you know, who doesn't know Apple? But the con here is that growth stock companies usually pay little to no dividend, and chances are you are paying a premium for them. And speaking about costs, do check out Tiger Brokers as they provide a real low fee for US and Hong Kong stocks, and even the Singapore market as well. If you sign up with the link in the description, you'll get 5 free trade, level 2 market data, which will give you a lot of information about the stock that you have in mind. I'll leave the links in the description down below. Like the recent Roblox IPO, the IPO price was $45, but when it opened on the market, it opened at $72. And personally, I feel that the tech space can be very crowded. With so many tech, fintech, martech firms out there, spotting a winner might be very hard. Hence, the risk here is pretty high as well. So based on a risk factor of 1 to 5, 1 being the least risky and 5 being hell as risky, I'm giving them a 3 because picking a winner is not something that you can do consistently over time. And in most cases, growth stocks are usually very tech-based, and this gives 2 problems. Or at least what I feel these 2 problems are. Number 1, it's very easily replaceable or has a narrow economical mode. And number 2, it requires a lot of innovation to keep up with the market. So for example, Facebook, which is a growth stock, has been getting a lot of bad media in the last couple of years, you know, with data breaching, hacking, and leaks amongst other things. But for the younger viewers, we essentially did already have Facebook even before Facebook existed. And it was called like Friendster or MySpace. And then after a few years, Facebook came up and essentially took over the whole industry. Next, we have trend stocks, or what I like to call meme stocks. So this is actually my own personal opinion, do not get too agitated, it's just what I feel. And in this category of stocks, I wouldn't take them too seriously because it's all market sentiment, and that is really irrational and it doesn't make any sense at all. So some of this includes GME and AMC. What happened is a sudden trend occurs because certain people tweet about a certain company, or a Reddit thread starts a revolution, or just something that suddenly comes into trend and it goes crazy high into the sky. Like GME, for example, it's a physical shop selling consoles, DVDs, and other peripherals, which most of them are being bought via e-commerce nowadays. Even PS5 is offering digital copies of their games. So is GME really worth what it is worth in the market right now? And like tech stocks, buying a meme stock can make you a huge fortune overnight. Being able to ride the wave, which will enable you to make life-changing money that can help many people as well. This might look like a good pro, but like a coin, the flip side of it is that you're timing the market and trying to not be the last fellow buying this stock. And when the trend dies off and you enter it, you are essentially setting up yourself for a huge loss. Chances are the whales have probably sold off majority of their shares and now finding someone to buy the remaining ones that are left in their hands. And remember, it's always a willing buyer and a willing seller situation. So it's hard to evaluate the worth of GME, for example, when there are many other technologies out there that has been and will be replacing them. So when it comes to risk factor, I'll give trend stocks a 6 out of 5, which is like, no, I'm not going to touch them. Oh hell no! And just for the mere fact that it's almost impossible to evaluate or measure the business with hard facts, it's like gambling, right? And last but not least, these are my favorite stocks, which are the dividend stocks or the ETFs. For the mere fact that once you purchase them, it keeps paying dividend moving forward. So what a dividend stock does is it shares the profits of the company to its shareholders in forms of dividends, which are paid either monthly, quarterly, biannually, or annually. And some of these dividends can range from a ratio of 1% to 15%. And definitely the higher the dividend payout, the riskier the stock is. Needless to say, the pro of a dividend stock or an ETF is the ability to earn passive income with a one-time effort of looking up the business, reading and researching on the stock or the ETF. And if you have a huge enough investment, you might be able to get passive income that might replace your active income as well. Although it might look all good and dandy, but then, there are always cons to it as well. With dividend stocks, one might not see huge gains over time, and this is usually for long-term investors as compared to short-term traders. Dividend stocks are like snails, they crawl towards the finishing line, while growth stocks are like rabbit running towards the end goal. If you're looking for higher growth or a short burst of growth, dividend stocks might not be suitable for you at all. So the risks involved with dividend stocks are usually lower as compared to its counterparts like the growth or the trend stocks. However, one thing to look out for is actually the payout ratio. A payout ratio above 60% is usually higher risk as compared to one that's below 60%. Basically, a payout ratio is how much of the company's profit is being used to pay to shareholders in the form of dividends. A PE ratio of 60% means the company takes 60% of the profits to pay out into its shareholders, which means less money for innovation and R&D. So here's my investment strategy for 2021. And keep in mind, this is not financial advice and just my own take on this. Because everything is pretty shaky with a lot of unknowns, I've taken a safer route. Majority of the portfolio are in blue chips and dividend stocks. This allows me to constantly generate cash flow for my monthly purchases that I do with the small investor account. Even with a small investor account, I focus on dividend stocks because it frees up my mental capacity and allows me to focus and get good at my work, earning me more money, giving me more capital to invest back on a consistent basis. Definitely, I do have stocks that are a little bit riskier, and this constitutes about 10 to 20% of my portfolio. On top of that, I do have crypto, which is already crazy and insane as an instrument for investment. That's why I'm balancing out my portfolio with safer stocks or ETFs. So do keep a lookout for next week's video as we'll be buying another stock for our small investor account, and I'm really excited about it. If you're looking for a broker, do check out Tiger Broker's descriptions are in the link down below. And if you have enjoyed this video, do give it a thumbs up, subscribe if you haven't, and I'll see you in the next video. Bye!